What if you could really get under the hood of a major global tech player in just one deep dive? Uncover the strategy behind, well, record-breaking results in what's still a pretty dynamic world. Today, we're diving into TE Connectivity. That's TAL on the NYSE. They're a powerhouse in connectivity and sensor solutions. Think next-gen transportation, the energy grid backbone, automated factories. Their stuff is absolutely crucial. You've shared the latest earnings call, the financials from TE, and our mission today is pretty clear. Cut through the noise, pull out the key insights, understand maybe the surprising bits behind the success, and figure out what it all means going forward. Okay, that's the setup. Let's start peeling back the layers. What really fueled this record quarter?
Yeah, it's definitely a compelling story here. TE Connectivity just put up a quarter with some really impressive records. It shows they can execute, amidst all the global dynamics, not just ride a wave.
Absolutely. I mean,
Yeah.
you look at their Q3 for fiscal 25, double-digit increases basically everywhere. Record net sales, $4.5 billion. That's up 14% reported year over year, and maybe even more telling, a strong 9% organically.
And it's not just sales, right? Adjusted earnings per share hit a record $2.27. That's up 19% from last year. Impressive. Adjusted operating margins, also a record, 19.9%, almost 20%. That shows real efficiency gains. Plus, the cash generation was, frankly, exceptional. But $1.2 billion in cash from operations and $962 million in free cash flow just for the quarter. Just for context, year to date, their free cash flow is already around $2.1 billion.
That free cash flow conversion, you mentioned it's well above 100% for the year. That's a huge signal, right? Turning more than every dollar of net income into actual cash, great for reinvesting or returning to shareholders. And their orders look solid, too. $4.5 billion, growing year over year and sequentially. Supports the future outlook. What did the CEO, Terrence Curtin, have to say about it all?
Yeah, Curtin really stressed that this wasn't just luck or, a rising tide lifting all boats. He pointed straight to the diversity of their portfolio and their global footprint as the key enablers. Allows them to execute effectively, even in, as he put it, a dynamic global environment.
So it's not just market tailwinds. There's a strategy behind this, right? What's the blueprint here? How did they manage this with all the global volatility?
Exactly. This wasn't accidental. It's really the result of strategic moves, investments they've made. They're very deliberately plugged into these long-term secular growth trends. You see it in both transportation and industrial segments.
And if we drill down into those trends, what are the specific drivers? You hear a lot about AI, right, and energy applications. These seem to be key areas where TE's products, especially those high-speed data and power connections, are just essential. But here's something that caught my eye. Over 70% of their production is localized globally. That sounds like logistics, but what's the real strategic edge there, especially now?
That 70% localization isn't just a footnote. It's kind of a strategic mode these days. It means TE can react faster to what's happening regionally. They can sidestep a lot of the global supply chain messes others might hit, and crucially, tailor things faster for local customers. That agility is a real competitive advantage in volatile times. It's proving invaluable. And their core strength, like you said, investing right where that higher speed data, those power connections are needed most, that focus is paying off big time, especially if we look at the industrial segment.
Yeah, the industrial segment really jumped out. Over 20% organic growth in Q3. That's a serious acceleration. It pushed the segment's total sales worth of 30%. Incredible.
And the margins there are just as impressive. Adjusted operating margins expanded by almost 400 basis points year over year. That's nearly 4 percentage points, now running over 20%. They attribute this to footprint consolidation, optimizing where they make things, and volume leverage. Basically, more sales mean lower cost per item. It really shows how operational tweaks plus strong demand can seriously boost profitability.
Okay, let's talk about that AI story within industrial. Digital data networks grew over 80% organically. Last year, AI revenue was $300 million. This year, they expect over $800 million. And they're projecting over $1 billion next year based on current run rates. That is genuinely explosive.
It really is. And what's interesting is management noted the margins on the AI stuff are, quote, a little bit above where the industrial segment plays. So even more profitable, which, raises the question, how long can this last? Management seems to think they're still in the middle to early innings here. They're working on next-gen programs with a broad slate of hyperscalers. Think the big cloud guys, Google, Amazon, Microsoft, not just betting on one horse.
That long view is key. And they're putting their money where their mouth is, right? CapEx up almost 30% this year, and most of that going directly into AI to support the scaling, the new product development. Is there any risk here, though, like getting too reliant on AI or new competitors jumping in?
That's always a valid concern in a hot market, definitely. But TE's position isn't just about riding the AI wave. They're providing these fundamental, highly specialized components. Their connections are basically critical plumbing for these hyperscalers. Competition's always there, sure, but their engineering depth and those long-standing relationships create, well, pretty strong barriers to entry.
Okay, so beyond AI, the energy business is also firing on all cylinders. Sales up 70%, including acquisitions, but still a really strong 20% organic growth. What's driving that?
That's mainly coming from momentum in what they call grid hardening, basically strengthening the power grid against outages, getting it ready for renewables, and of course, renewable projects themselves. It's particularly strong in the North American utility market. And that big acquisition they made, Rich's Manufacturing, for about $2.3 billion back in April, that really broadened their exposure to grid hardening, specifically in North America. Gives them an even bigger piece of that crucial pie.
Makes sense. And the other parts of industrial are doing okay too. Automation and connected living grew 5% organically. Sounds like factory automation might be waking up after a soft patch. Aerospace, defense, marine up 6% organically too. Good demand, supply chains improving. Medical was roughly flat though, as expected. Some inventory adjustments happening there. So yeah, mostly a strong story for industrial.
Right. Now, shifting over to the transportation segment is more of a mixed bag, navigating different regional speeds. Their core auto business grew 2% organically in Q3, which is pretty decent actually, considering global auto production was slightly down overall, and they expect it to be roughly flat for the full year.
Yeah, definitely navigating unevenness. The regional split is quite stark, isn't it? Asia's still a major bright spot. Orders up 17%, sales up 11%, and that's half their auto revenue right there. But then Europe and North America, the Western markets, saw declines of 5%, hit by lower production and maybe fewer EVs rolling out in those regions. What's behind that split, and how's TE managing it?
Yeah, the difference really reflects varying economic conditions and kind of different speeds of EV adoption. Asia, especially China, has seen stronger auto production generally and maybe a faster ramp on some of these next-gen EV platforms where TE has a lot of high-value content. In the West, maybe more consumer caution, a bit of a slower transition to some new EV models. That directly hits TE's sales for those specific components. But despite those headwinds, the company keeps highlighting key wins in data connectivity and electrification. That's what drives future content growth per vehicle. Basically, their tech is becoming more vital for the next wave of cars wherever they're built.
Right, playing the long game on content. Commercial transportation also saw 3% organic growth, orders improving a bit.
Sensors business, though, a bit weak in the West, offset by Asia again. What about margins and transportation? Despite those regional issues, they seem pretty healthy. They are, yeah. Adjusted operating margins for transportation were 19.4%, and they expect to be above 20% for the full year. That shows pretty solid execution, holding on to profitability even with those regional production shifts. Speaks to the value they're adding to each vehicle.
Okay, let's pivot to the financials supporting all this. The cash generation, capital allocation. We talked about the strong cash flow, the healthy balance sheet giving them options, that free cash flow conversion well over 100% again. So with all that cash, what are they choosing to do with it? What does that tell us about their priorities right now?
It looks like a pretty balanced approach, actually. They returned $1.5 billion to shareholders so far this year, dividends, share buybacks, and they still have $1.8 billion left on their repurchase authorization. At the same time, they spent $2.6 billion on acquisitions, mostly in industrial, including that big Richards deal we mentioned. Management also said the pipeline for smaller bolt-on deals, especially in the fragmented industrial space, looks good. So they're still hunting for strategic growth via M&A.
And they're keeping an eye on costs, too, expecting about $110 million in restructuring charges for fiscal 25. But that should yield about $70 million in annualized savings by the end of fiscal 26. Shows they're being proactive on efficiency.
Definitely. On the macro side, a weaker U.S. dollar actually helped them a bit. Tariffs. Minimal impact, they say, mostly managed through sourcing changes in pricing, and management doesn't see customers pulling orders forward because of tariff fears, which is interesting. Now, there was a big tax item mentioned, a $574 million income tax expense related to Pillar 2 guidance. What exactly is that, for those of us not deep in global tax? And why did it hit a Swiss tax credit?
Right, Pillar 2. It's basically part of a global effort to set a minimum corporate tax rate. The idea is to stop companies from just shifting profits to super low tax countries. In TE's case, it specifically affected a Swiss tax credit they'd been using. It's a really complex global tax shift lots of multinationals are dealing with right now. They also mentioned they're looking at the impact of the new One Big Beautiful Bill Act in the USOBBA, which could affect their U.S. taxes too.
Okay, got it. So looking forward then, how are they planning to keep this momentum going? What's the outlook? For Q4 fiscal 25, they're guiding pretty strong. Net sales around $4.55 billion. That's about 12% reported, 6% organic growth. And adjusted EPS around $2.27 again, which would be a 16% increase year over year.
Yeah, that Q4 guidance implies, strong high single-digit sales growth for the full fiscal year 25 and double-digit adjusted EPS growth. That's solid. Management sounds confident about the durability here, especially because so much seems tied to those big secular trends. Electricity growth, AI, gives them even more confidence, they said. Crucially, it feels less like just a cyclical bounce and more like they're tapped into fundamental shifts.
Exactly. And on long-term margins, they didn't give specific targets, but they measure success by hitting what they call incremental flow-through of 30% or better on organic growth. Meaning, for every new dollar of organic revenue, at least 30 cents should drop to the operating income line. If they keep doing that, margins will naturally creep up over time. It really suggests they're focused on leveraging these strong market positions in AI, energy, and so on to drive profitability consistently.
So summing up, we've seen how TE Connectivity's strategic bets on high growth like AI and energy, combined with smart operations, that localization strategy, it's all fueled these record results. Their focus on the absolute fundamentals data and power connectivity really puts them right at the heart of these major global shifts. So here's something to think about. Given the company sees itself in the middle to early innings of AI and how foundational their role is in building this smarter, more connected infrastructure, what new challenges or maybe opportunities pop up as these technologies get even more woven into our daily lives? And how could that reshape what connectivity even means in the future?